When an economy enters a recession, financial markets react with volatility, uncertainty, and often sharp declines in asset prices. But this does not mean investors should panic or retreat entirely. Instead, a recession presents a recalibration opportunity. Assets that were previously overvalued may now trade closer to intrinsic value. Sectors that were overheated may cool to sustainable levels, and disciplined investors can position themselves for long-term gains by understanding the mechanics of downturns. The key is not to avoid the storm, but to learn how to navigate within it, adjusting sails, not dropping anchor. This requires a clear understanding of macroeconomic signals, sector resilience, and personal risk tolerance. Many investors mistakenly believe recessions are uniformly destructive, but history shows that strategic positioning during downturns often leads to outsized returns during the subsequent recovery. What matters is not timing the bottom, but structuring a portfolio that can withstand pressure and capitalize on dislocations. Liquidity, diversification, and cost control become even more critical when revenue streams contract and credit tightens. Emotional discipline is non-negotiable. Decisions driven by fear or media hype rarely produce optimal outcomes. The goal is not to predict the duration or depth of the recession, but to build a framework that performs regardless of either. Start by auditing your current holdings. Identify what is fragile, what is essential, and what is undervalued, then act with intention, not impulse. Sector selection during a recession is not about picking winners, but about avoiding structural losers and identifying businesses with durable cash flows. Consumer staples, healthcare, utilities, and certain segments of technology tend to demonstrate resilience because their demand remains relatively inelastic even when incomes shrink. People still need food, medicine, electricity, and digital infrastructure, even in hard times. Conversely, luxury goods, travel, entertainment, and highly leveraged industries often suffer disproportionate declines because their revenues are directly tied to discretionary spending. This does not mean you should avoid cyclical sectors entirely. It means you must evaluate them through a stricter lens. Strong balance sheets, low debt, pricing power, and operational efficiency become non-negotiable filters. Avoid companies that rely on constant refinancing or speculative growth. In a credit-constrained environment, these are the first to stumble. Look for firms with recurring revenue models, high customer retention, and low customer acquisition costs. Geographic diversification also matters. Companies with global revenue streams may offset domestic weakness with international strength. Do not chase yield blindly. High dividends during a recession can be a trap if they are not supported by sustainable earnings. Always prioritize cash flow durability over headline growth or past performance. Asset allocation must shift toward preservation and optionality during recessions, not because growth is impossible, but because capital preservation enables future growth. Reduce exposure to speculative assets, such as meme stocks and profitable tech startups, or highly leveraged real estate plays. Increase allocations to high-quality bonds, particularly those issued by governments or investment-grade corporations with strong credit ratings. These provide stability and income when equities are turbulent. Consider short-duration instruments to avoid interest rate risk if central banks are still hiking or signaling prolonged tightening. Gold and other non-correlated assets can serve as hedges, but they should not dominate your portfolio. Their role is insurance, not appreciation. Cash is not an enemy, it is strategic ammunition. Holding dry powder allows you to deploy capital when others are forced to sell, often at distressed prices. Rebalance systematically, not emotionally. Trim winners that have become overexposed, add to positions that have been unfairly punished, and avoid doubling down on falling knives without fundamental justification. Use dollar-cost averaging to mitigate timing risk. Consistent, incremental investments smooth out volatility and remove emotion from the equation. Avoid leverage at all costs. Recessions magnify losses, and margin calls can force liquidation at the worst possible moment. Your allocation should reflect your time horizon. If you are investing for decades, temporary drawdowns are noise. If you need the money soon, safety trumps return. Valuation becomes your most powerful tool during economic contractions, but only if you understand what metrics matter in a downturn. Traditional P/E ratios can be misleading when earnings collapse temporarily, so focus on forward-looking fundamentals. Free cash flow yield, enterprise value to EBITDA, and price-to-book ratios adjusted for asset quality. Compare current valuations not to recent highs, but to long-term historical averages and sector peers under similar stress conditions. Look for companies trading below liquidation value or with asset bases that significantly exceed market cap. These are potential margin of safety plays. Avoid value traps, businesses that appear cheap but are structurally impaired, losing customers, or facing irreversible disruption. Quality matters more than quantity. One truly undervalued, resilient company is better than 10 statistically cheap but fundamentally weak ones. Use recessionary periods to study balance sheets obsessively, debt maturity walls, interest coverage ratios, and operating cash flow trends reveal which companies can survive and which are skating on thin ice. Do not rely on analyst upgrades or media narratives. Do your own forensic work. Stress test every holding. If revenues dropped 20%, could this business still cover its obligations? If rates rose another 2%, would its debt become unsustainable? Valuation is not about finding the lowest price, it is about identifying mispriced durability. Behavioral discipline separates successful investors from emotional casualties during recessions. The human brain is wired to fear loss more than it values gain, a psychological bias known as loss aversion, and markets exploit this relentlessly. Headlines scream, crash. Charts flash red, and social media amplifies panic, but reacting to noise destroys long-term returns. Create a written investment policy statement before the storm hits. Define your goals, risk tolerance, rebalancing rules, and criteria for buying or selling. Stick to it religiously. Avoid checking your portfolio daily. Volatility is meaningless noise if your strategy is long-term. Do not try to time the bottom. Even professional economists fail at this consistently. Instead, focus on time in the market, not timing the market. If you are tempted to sell, ask yourself, has the fundamental thesis for this investment changed, or am I reacting to fear? If the business is still sound, hold or even add. If it is broken, exit, but do so analytically, not emotionally. Surround yourself with rational inputs. Read annual reports, listen to earnings calls, study industry trends, not Twitter threads or financial TV pundits. Remember, recessions are temporary, compound growth is permanent. The biggest mistake is not losing money, it is abandoning your strategy and missing the recovery. Cost management is not just a corporate imperative, it is a personal investment necessity during recessions. High fees, commissions, and expense ratios silently erode returns, especially when markets are flat or negative. Audit every cost associated with your investments. Switch to low-cost index funds or ETFs if active management is not demonstrably adding value. Avoid frequent trading. Not only does it increase transaction costs, but it also triggers short-term capital gains taxes, which are higher than long-term rates. Use tax loss harvesting strategically. Sell losing positions to offset gains elsewhere, but do not let tax considerations override sound investment logic. Consider moving to commission-free platforms and avoid products with hidden loads or surrender charges. If you are working with an advisor, ensure their fee structure aligns with your performance. Flat fees or assets under management models are preferable to commission-based compensation. Reduce lifestyle inflation tied to portfolio performance. Do not increase spending because of paper gains, and do not panic sell because of paper losses. Treat your investment portfolio like a business. Track inputs, outputs, and net returns after all costs. In recessions, every basis point matters. Compounding works in reverse when costs pile up. Efficiency is not boring. It is the silent engine of long-term wealth. Opportunity recognition during recessions requires a counterintuitive mindset. When others see danger, you must train yourself to see discounted potential. Markets overshoot on both the upside and downside. Fear drives prices below fundamental value just as greed drives them above. Identify industries undergoing forced deleveraging or indiscriminate selling. These often contain hidden gems. Look for market leaders with strong brands that are being sold off alongside weaker competitors. Their recovery potential is significantly higher. Monitor insider buying. When executives and board members are purchasing shares of their own company during a downturn, it is often a strong signal of confidence and undervaluation. Watch for spin-offs, restructurings, and distressed asset sales. These events frequently unlock value that the broader market overlooks. Do not ignore international markets. Recessions are rarely global in perfect sync, and emerging or developed markets outside your home country may offer better valuations and growth trajectories. Consider private market dislocations too. Venture debt, private credit, and real estate secondaries can offer attractive risk-adjusted returns if you have access and expertise. The key is patience. Opportunities do not disappear overnight, and the best entries often come weeks or months into the downturn. Wait for clarity, not headlines. Let panic create your entry points, but only act when fundamentals confirm the opportunity. Exiting a recession requires as much strategy as entering one. The recovery phase is not automatic, and missteps here can erase all the discipline shown during the downturn. Resist the urge to chase momentum blindly. Early rallies are often volatile and led by speculative assets that may not sustain gains. Reassess your portfolio's risk profile. As markets recover, gradually rebalance back to your long-term target allocation. Do not let equity overexposure creep in just because stocks are rising. Avoid revenge investing. Trying to recoup losses by taking outsized risks usually leads to further losses. Stay focused on quality. The companies that survive the recession with strong balance sheets and loyal customers are often best positioned to lead the expansion. Monitor macroeconomic indicators, employment trends, consumer confidence, credit spreads, and central bank policy, not to predict but to adjust. Do not assume the old normal will return. Recessions often accelerate structural changes in industries, consumer behavior, and technology adoption. Adapt your holdings accordingly. Finally, execute your call to action. If this framework helped you rethink your approach to investing during downturns, subscribe for more deep dive analyses. Like this video to support independent financial education, share it with someone navigating market uncertainty, and drop a comment with your biggest recession investing question. We will tackle it in the next video. Recessions are not the end of the road. They are a detour that rewards the prepared, the patient, and the pragmatic.